Have you ever stood on the edge of a calm sea, knowing a storm is brewing beneath the surface? You feel the stillness, the deceptive peace, but a primal instinct whispers that everything is about to change. That's where we are right now. We just experienced a flicker of hope, a rally in the markets, a sigh of relief. But don't mistake a pause in the storm for the storm's passing. Last week the narrative was simple. Choppy waters, yes, but a likely relief rally on the horizon. The thinking was, the worst of the news was priced in, and any positive shift would be amplified. It felt reasonable, logical, but the world rarely operates on logic alone. It operates on momentum, on perception, and on the unseen forces gathering strength. And those forces, they're shifting. The potential for positive news is dwindling, eclipsed by a growing anxiety. It's a feeling, a subtle tremor in the market's confidence, a nagging worry about something big, something disruptive, that's just over the horizon. What is it? A supply shock, a disruption to the very flow of goods that keeps our economies humming. It's not a question of if it will hit, but when. And the window is closing. 2 to 3 weeks. That's all. Imagine a complex machine, perfectly calibrated, running smoothly. Then a single vital component begins to falter, to slow down, to threaten the entire system. That's what's happening to the global supply chain. And the U.S. is about to feel the brunt of it. We're already seeing clues. Shipping rates from China to the U.S. are collapsing. Not a gentle decline, a slump. A dramatic fall that signals a major shift in demand, or more accurately, a growing inability to supply that demand. If this trend continues, and all signs point to it doing just that, we'll see the impact ripple through the U.S. economy around mid-May. Prepare for it. Now some will say, don't panic. It's just a correction. They'll point to economic data, to GDP numbers, to payroll reports. But let me ask you a question. How much weight should we really give to these lagging indicators when the world is changing at warp speed? When the real story isn't written in broad strokes, but in the fine print, in the high-frequency data, in the whispers of the market. Think back to the early days of the pandemic. The official numbers were slow to reflect the reality on the ground. It wasn't the GDP reports that told us what was happening. It was the empty shelves, the canceled events, the sudden chilling silence in our cities. We had to look beyond the headlines, to the granular details, to understand the true scope of the crisis. Are we entering a similar period now? A time when we need to tune out the noise and focus on the signals? I believe we are. GDP, for instance. The first quarter numbers coming out this week. They're already outdated. A snapshot of an economy that no longer exists. These figures predate the latest round of tariffs, the escalating trade tensions, the looming supply shock. They show a slowing economy, yes, but they don't capture the full impact of the policies that are about to unleash even greater disruption. It's like trying to navigate a ship using a map of a coastline that's been dramatically altered by a recent earthquake. Don't be misled by the headlines. They might scream about slowing growth, but the real story is about impending contraction. The theme of Sell America isn't going away anytime soon. In fact, it's likely to gain momentum. What about payrolls? The monthly jobs report, always a market mover. Is it the key to unlocking the Fed's next move? Will a weakening labor market finally force them to intervene, to ride to the rescue with more stimulus? Perhaps, but I'm not convinced we're there yet. Initial jobless claims haven't shown sustained weakness. The labor market, while softening, hasn't cracked. Not yet. The Fed is watching, of course, waiting for that critical signal. But they're waiting for a tremor, and right now, they're feeling only a slight wobble. However, the ISM Manufacturing Index, that's a different story. That data point does matter. It provides a more timely and accurate picture of the health of the manufacturing sector, which is particularly vulnerable to trade disruptions. Pay attention to that number. But ultimately, everything comes back to trade, to tariffs, to the escalating conflict between the US and China. It's not just about the headlines announcing new tariffs. It's about the cumulative effect of all the trade barriers, the restrictions, the uncertainties that are choking off the flow of goods. It's about the silent, insidious damage that's already been done. We flagged this last week, a marginal positive outlook on the headline trade news. But that was a mirage. The real damage is happening beneath the surface. We're witnessing the emergence of an effective trade embargo between the US and China. And with it, a supply shock of unprecedented proportions is heading our way. This isn't about predicting the future. It's about recognizing the present, about understanding the forces at play, about acknowledging the risks. So where does that leave us? Choppy markets, absolutely. But the nature of those choppy waters is changing. Last week's choppiness was a relief rally in disguise. This week's choppiness is something different. It's a neutral tone masking a downward drift. A lull before the storm. The next big move is going to be to the downside. And we're searching for the catalyst now. The trigger that will unleash the selling pressure. What does this mean for traders? It means the risk-reward ratio has shifted. The opportunity to profit from a continued relief rally is diminishing. It's becoming increasingly dangerous to chase the upside. This isn't about fear-mongering. It's about prudence, about protecting your capital, about recognizing that the tide is turning. Think of a sailboat caught in a changing current. You can fight against it, straining every muscle, desperately trying to maintain course. But eventually, you'll exhaust yourself. And you'll likely end up further off course than if you had simply adjusted your sails and allowed the current to carry you. Sometimes the smartest move is not to resist the inevitable, but to adapt to it. We are entering a period of heightened uncertainty, a period of increased volatility, a period where traditional investment strategies may no longer be effective. The old rules no longer apply. Don't be lulled into a false sense of security by the recent rally. Don't be distracted by the noise of the headlines. Focus on the underlying trends. Pay attention to the high-frequency data. And prepare for a significant correction. Consider this: the best investors aren't those who predict the future with certainty. They're those who understand risk, those who manage their exposure, those who protect their capital. What we're witnessing isn't simply a market correction. It's a fundamental shift in the global economic landscape, a realignment of power, a reckoning for years of unsustainable policies. It's a time for caution, a time for discipline, a time for strategic thinking. Imagine a forest fire slowly creeping towards a town. You can ignore the smoke, dismiss the warnings, and hope for the best. But that's a dangerous gamble. Or you can prepare. You can evacuate. You can protect your property. The smoke is here. The warnings are clear. Are you prepared? This isn't a time for complacency. This is a time for action. Not reckless action, but informed, deliberate action. The storm is coming. Don't be caught unprepared. The question is whether the market will fall. It's when, and how far, and whether you'll be ready. Remember that feeling on the edge of the calm sea. The deceptive piece. Don't let it fool you. The storm is brewing, and it's time to batten down the hatches. Because in the face of uncertainty, the only true certainty is that change is coming. And the ability to adapt, to anticipate, to prepare, that's the key to survival. That's the key to thriving, even in the midst of the storm. Don't chase the fading light of a relief rally. Focus on building a fortress for your portfolio. The future isn't about predicting sunshine. It's about weathering the storm.